Good morning, everyone. It's Ken Angst with Hope Properties NV, the Angst Real Estate team. We're once again at it this week with a new guest. She has never been on the podcast, so we're welcoming in Jennifer Fiore with Guild Mortgage. How are you doing?
I'm doing good. Thanks for having me.
Thanks for coming in. So how we met Jennifer was through a recent transaction. Our buyers already had you as their lender, and we were impressed with what's going on in the transaction, so we thought we would interview you and get your kind of viewpoint on what's going on in the market from the lender perspective.
Awesome. So, well, thank you.
Tell our clients a little bit about yourself. How can you help them with mortgage refis? Kind of give them a little 30-second commercial on what you're doing.
So I've been in the industry now for about 17 years, been at Guild for about 8. Best part about Guild, I can tell you, is we're local. So underwriters, processors, everybody's here in town. We treat our customers as customers and not just another number.
And that's important because particularly in this transaction, I can tell you right now is our customers won this contract because there was multiple bids because they saw your name. And the other agent said, we know that Jennifer's team is closing. So that's another reason why to use a local lender that has a good reputation in the industry.
Exactly.
Because it does win contracts when there's multiple bids.
It can, yes.
So keep that in mind. A little bit more about you.
I am not born and raised here in Nevada, but from Colorado. I've lived most of my life here since 1994. It's home now. I have a team with me. I have about 3 girls that are on my team. 2 of them are licensed. We do that so that we can be available for you anytime there's questions.
Weekends.
Yep, weekends, evenings, we work all the time. So biggest thing on our team is we like questions. So don't be afraid to ask. Communication's huge on our team as well. So we always want to make sure you understand every little piece of the transaction, the loan, what you're getting yourself into, the ins and outs.
Perfect. So that's going to be a good segue into our little rapid fire session.
Yeah, sounds good.
Because we're going to cover a lot of questions that come up. Basically what I've done again is this podcast is all about educating people. And what we've done is gone through the offer and acceptance that buyers sign and going to ask them the questions that mostly come up.
Okay,
Ready?
Sounds good.
Okay, so we're going to cover, the biggest question is, what is an FHA loan? That's the biggest question. And then if you can talk about who is this Fannie and Freddie?
Okay, so an FHA loan is backed by the Federal Housing Administration. It has a 3.5% minimum down payment. It requires mortgage insurance, no question asked. You can put 50% down, still has mortgage insurance. So it's considered a government loan. That just means that FHA owns the loan after it closes.
Okay.
Just as on a conventional side, Fannie Mae or Freddie Mac will own that loan once it closes.
Excellent.
They are also technically backed by the government at this point from a few years back. But they don't always require mortgage insurance on the conventional side where FHA does.
Okay, so one of the questions that come up a lot is, so you're getting, I don't know if it's PMI, is it mortgage insurance or MI now?
PMI is property mortgage insurance, but you could call it PMI or MI.
So mortgage insurance, MI.
Yeah.
So when you get an FHA loan, to get it off there, you have to refinance, correct?
Have to refinance it.
Okay, so if you're doing like a conventional, which is 5% down?
Yep. Sometimes 3. Sometimes
3.
Okay.
3. So talk to her about what
the 3. Yeah.
The 3. And then, but once you get to what value can you, what's the process of getting it off if you're in a conventional, that mortgage insurance?
So technically, it depends. So if you want to do it without doing a refinance on the conventional side, then you're going to want to have about 25% equity in the home. But once you have 20% equity, you could refinance. But who wants to spend a few $1,000s if you can avoid it? So really try to shoot for...
If you get 25, it can drop off. Do they have to do an appraisal?
They do. They have to establish that value. And there is a minimum time frame. So let's say you bought today on a conventional loan and you wanted to remove it in a year without refinancing, there's a minimum 24-month wait period. So you got to make 24 months payments.
Excellent. So I think the thing that people need to know is talk to Jennifer and her team about what kind of loan fits.
Exactly, and that's what we're going to do. We're going to show you multiple options. That's our job. Here's the option A, option B, option C, and show you the pros and cons of each. Then you get to decide which one works best for you.
Last question I have is, what is there a percentage, or how is the mortgage insurance amount? Obviously, it's about prorated on what you put down, but how do they figure out the amount every month that they charge people?
Depends on the type of loan. So real quickly, FHA is set. It's the same for every single person. It
Is it a
doesn't
percent?
change. It is 0.85 per month.
I didn't even know that.
Yeah,
So,
0.85 per month.
of the loan amount.
Of the loan amount.
Okay.
But on conventional, it depends on credit score, down payment. So there's other things that impact it. So the better the credit score and the more down, the less your mortgage insurance will be.
So we learn everything. We learn something every day.
Yeah.
So great information. So it's set for FHA, and then it kind of depends on your situation and credit. So
Correct. Yep.
All right. So we're gonna move on
Okay.
to the next question. You ready?
Yep.
I
feel like we're playing double jeopardy
That's
almost
right.
in a way.
We're gonna try and stump you here. Let's hit rate locks.
Oh, yeah.
So what is a rate lock, and when do you set it, and how's it related to a real estate contract? Because there is a line on there for it.
Yes, there is. So it depends on the type of transaction and how long you want to lock it for. A rate lock basically is protecting the consumer, the buyer, from rates going up.
Okay.
So if you think rates are going to go up and you lock your interest rate and they do go up, you're locked in at that lower interest rate. So it's a protective step to help the borrower.
So what's your philosophy? Because every lender has a philosophy.
My philosophy is lock it.
Lock it if it's
Interest
low.
rates are so
So
low.
low.
Lock it. Don't take the chance. For every eighth that may change your payment $20. It's not huge. So it's not worth the potential of it going.
Rate lock is,
Rate lock.
and then what's your philosophy on when you should lock it if you're in it? And then is there different extensions you can get or?
Yeah. So the standard turn time or rate lock we do is 30 days, whether it's a refi or cash out or a purchase. Excuse me. You can go as long as 90 days in a regular transaction. However, we also have something called an extended builder lock, which will actually lock your rate for 6 months, which is really nice when the market starts moving and you're buying new construction, you can lock it for longer. But let's say we locked it for 30 days and then we need a couple more days. Something happened, it couldn't close, they went out of town, whatever. There are what we call extension fees.
They're expensive.
It can be. It depends. Is it a day or two or is it 30 days?
Okay.
Kind of like interest rates and locking them. The longer you lock a rate for, the more expensive it gets. So the longer you have to extend it for, the more expensive it gets.
Okay.
So
anything else about rate locks? That's about it.
just lock. Don't
Just
take the
lock,
chance.
and typically what we're seeing, how fast are you guys on average on your end closing deals?
30 days.
30 days.
Yeah.
So if you get a 30-day
Yeah.
and do it like 5 days in,
Yep.
you're good.
You're good.
Okay. And that's a line on the offer and acceptance that we explain to our customers. Usually we give you 14 days to lock it.
Yeah.
And
Yeah.
then-
Most people, I say 90% of people lock it once you're in contract.
So again, that'll be the discussion you have with Jennifer, and we'll discuss that too. All right, so we're going back. Haven't stumped you yet. The biggest discussion are what are points, and how does it relate to a real estate transaction?
That actually works really well with rate locks. So when we sit down with a client and talk about what interest rates are, we're going to give options because rates and fees, i.e. points, work on a sliding scale. So when your rate goes up, your points go down, or there's no points, so your fees go down. Whereas if you want your fees to be lower, no points, your rate might be a little bit higher.
Okay.
So a consumer can decide to choose the highest rate possible and have very little to no closing costs, or they can decide to take the lowest rate possible and have the highest closing costs.
So
everybody's normally right in the middle. Nobody
yeah.
likes
So
to do either.
what is a point? I mean, what is that?
One point is 1% of whatever your loan amount is.
Okay,
so
it's
if your
not
loan
your
amount's
offer.
200, no,
It's your loan amount.
loan amount. So if your loan amount's 200,000, it's $2,000.
Okay, so I guess they're right in the middle. So what's the highest you've ever seen someone buying?
Oh wow. Highest points buying.
Yeah. And you're just
usually
buying
right around 2 is the highest.
So,
you see.
but when you buy a point, just to be clear, you're actually buying down your interest rate.
Correct.
So what is 2 points? So what does a 1 point get you, or is it kind of?
It changes
on the
every day.
market? Okay.
So it's not like 1 point, 1% of your loan amount gets you a 1 point rate reduction. It's not the same.
Okay.
One day it could be a quarter of a point better.
It just depends on the market.
Depends on the market. Exactly.
Okay.
Yeah.
So keep that in mind. The one thing that you should take out of this is 1 point is 1% of your loan amount.
Mm-hmm. Exactly.
Okay, great. Good discussion. Moving on here. A lot of questions we get, particularly in this market, is why does a lender get an appraisal done on a home?
So
She said this was a complicated question, so.
yeah, it is because there's a couple pieces to it. So first and foremost, it's important. Say I'm going to loan you $200,000 on a property.
Yep.
As that investor, wouldn't I want to make sure that that property is actually worth $200,000?
Yep, makes sense. So it's just basically an evaluation to make sure that you are giving a loan on a property that we know it's worth that.
Exactly. But there's situations where it might not be needed. So on a purchase or on a refi, there are times that lenders will get something called a property inspection waiver. Okay. And we won't know that until we run your all of your information through the system, and it tells us, I believe the value you input there, say the $500,000 for the purchase price, is legit, so we won't need a property.
But you won't know that until you actually know the physical address and you have an offering.
Correct. We can't guess. Yeah.
Okay. So how often is there you seen that?
Depends on for people. So there's some pieces to it that have to kind of come into play. You can't put the minimum down and have low credit scores.
Okay.
So you really have to have 10 to 20% down, great credit, low debt to income ratios, and that's normally when the system would fire. I would say probably 60-70% of the time.
Wow, so quite a bit.
A lot. Yeah.
Okay, great. Does it ever happen on FHA? No.
It's Fannie Mae, Freddie Mac.
Okay, so it's not VA or FHA.
No.
Those are. And what are you seeing for the cost of an appraisal? This shocks people.
Wow, that can range too. The average is about $600. I've seen some come in as high as $1,000 based on location being farther out of town, more complex.
We just had one at $1,800.
Whoa!
Out in Cold Springs, it was a mobile home.
A mobile home, so
couldn't get anybody to come out for $1,800. So it can go up as high as $1,800.
That's crazy.
So keep that in mind because that's an out of expense, out of your pocket. You don't get that back if you don't.
You do not.
So a lot of people think that they're going to get that money back, but once the appraisal is done, it's done.
The service has been completed.
So all right, so we're moving on. Now this is something that I didn't know about, but we're going to clear it up because I get a lot of questions on the contract. There are two different title insurances,
right?
And typically in our market, but it's negotiable. The seller is paying for the owner policy,
right?
And the buyer is paying for the lender policy. What is the difference? Because a lot of people are like, I'm getting title insurance. Why do I need a title insurance to pay for the lender?
So the simplest way to break it down is the owner's title insurance policy is to make sure everything on the current owner, which would be the seller now, is being removed and removed from the property so that everything is paid off. There's nothing that's going to come back.
So if there's an issue, that policy is the one that would cover if there's anything that was left.
With respect to the current
Does
sellers.
It cover all the sellers that have ever been associated with that property? Or?
No, my understanding is the time frame of when that person took out that original title policy.
Okay. So
that's why when you refi, they make you get a new title policy because it starts new dates.
Interesting.
Yeah.
So when we can talk about that in a second. So what does the lender policy cover?
So the lender's title insurance policy is to protect the home buyer and the lender from any potential liens that could be attached to the property from the moment the new home buyer owns it to when they sell it or refinance to a new transaction. Okay. Contractor liens, there could be so many different things that could be attached to the property. They try to protect it and make sure that the home, the title is free and clear, nothing's encumbering it that shouldn't be.
Okay, so when you pay off your house, what happens to the lender policy? Is it still in place?
It's still there, technically.
Okay.
Yeah.
Interesting.
Unless you were to refi and get another one.
Okay, but when you refinance, you have to redo it all.
You have to redo your lender's title policy. Yeah.
Interesting.
Yeah, it's a new loan, new dates.
Okay, so so we're done with questions about the offer and acceptance, and it kind of leads us right into our last question.
Yeah.
And we have a lot of people out there, interest rates are great, but I still have a lot of clients still paying 5%. And so the question I have is, when should our clients consider a refinance?
So this is more of a personal choice. For me personally, I will not refinance my house unless I can recoup the cost of the refinance in the first 24 months.
Okay, so that's one of my questions I have here is, what are the fees associated with a refinance? I know that there's a appraisal, and I know now there's title insurance.
Yes.
What else?
So roundabout, we're going to tell somebody it's about $3,500. Depending on points, we got to bring in those points again. Are you going to pay points? That doesn't include points.
Okay.
That $3,500 is going to cover the expenses from guild, the appraisal, the title fees, what have you. So in the end, you want to make sure that if you're saving $300 a month, just simple math.
That's
right?
great. If you can do that, just do it. That's less than 12 months.
That's
You
less
divide
than
by
12 months, exactly.
So if it's 36, let's just make it
sense.
3,600 divided by 12 is you're recouping 30. So 1 year.
1 year you've recouped
and
your
she's
costs.
saying
that
24 months.
I'm saying 24. That's a personal choice.
I like 16.
Yeah.
But
some people go as far as 36 months. That's the farthest I've really seen.
But just keep in mind, if you're thinking about moving out of the house,
then it's
don't be ready to refinance.
Don't refinance. Yeah, unless you're planning to pull potentially money out for a purchase or something.
Right.
There are situations.
And then the last question is, what is a cash out refi? Because I know people are asking about that. They have some credit card debt, school debt.
Yep.
What is a cash out refi and how much can they take out?
So cash out refis allow you to pull up to 80% of its value. So that's the max loan amount you can get for owner occupied for pulling cash out. And you got to be careful, right? Are you taking a trip to Italy? Or are you renovating your house, putting the money back into it, paying off high interest rate debt? That, again, is kind of where you get a chance to see if I just paid off $400 one monthly, let's say $10,000 credit card I had that has a $400 a month payment on it, and I add that same $10,000 to my new loan on a cash out refi, it's only going to change my payment $50.
Okay.
Right there, I just saved $350 a month. That makes sense.
Right. So it has to make sense, and I'm assuming that you will counsel people on how to make sure that it makes sense.
Yeah. The more money you pull out, the more expensive it gets. So you don't want to go crazy either.
And are you seeing people do 15 or 30 years? What are your clients doing?
I have a lot of people calling about a 15
What's the spread?
year.
What's the spread between the 15 and the 30 year?
3/4 of a point to a point in rate. Yeah. But we get a lot of interest in the 15 year. We actually see more people go to a 20 year because the 15 is just so much more.
It's double your payment.
It is. And so the 20, they go with the 20 year, or a lot of people really are even taking their 5 1/4 30 year fix that they have right now, refinancing to a low 3% range 30 year fixed, and whatever savings that they save, say let's again say 350, they're just putting it back on, and now they just by themselves and doing that changed it to a 20 or what have you.
Yeah, so if you make one extra payment, this is my calculation, so tell me if I'm wrong.
Okay.
If you make one extra payment a year and you start out a 30 year fix, you can get it down to like a 22 or 23 year.
Right, depending on the loan amount. Right.
So keep that in mind that I'm a big proponent of not getting overwhelmed.
Right.
If you get a 15 year, you're sticking with that.
Yeah.
And I see some people get in trouble with that.
We're seeing people switch back now from a couple last year who went to 15. They're now going back to a 30.
So get a 30, and then just pay more. And then when things are tight, don't pay as much.
Exactly.
And then you can easily get it down to a 22 by just paying one extra payment.
Exactly.
So, all right, you're awesome.
All right, thanks.
I'm glad that you came in, and new blood in our podcast is awesome. So hopefully we can do it again soon.
Definitely.
And so if you guys are out there, we're trying to provide quality information about real estate in Northern Nevada. We'd love you guys to like our videos, ask questions, subscribe to our channel, and we're going to have a lot more information coming out on a weekly basis. So guys, have a great week, and hopefully the smoke clears.
Hopefully.
Kind of tired of that.
Fingers crossed.
So guys, have a good one. We'll talk to you soon.